And today is not a good day for those who are betting for the greenback. Once again, the dollar's getting slammed. It continues to weaken. Today it hit a 3-year low against the Japanese yen. And the yen is just the latest currency. It seems every time you turn around, there's new lows set in the dollar against some currency or other. Yesterday, the euro, we hit 3 consecutive record lows against the euro. So we posed the question, and this came up in yesterday's testimony by Mr. Bernanke in the Q&A session. Is the dollar still king, or are other currencies chipping away at the greenback supremacy? That discussion now with Dan Mitchell, Senior Fellow at the Cato Institute, Christian Weller, Chief Economist for the Center of American Progress, and we're also joined by Rick Santelli, Michelle Caruso-Cabrera, and Dennis Neal. So everybody's on board with us today. Dan, let me start with you, because the last time we chatted, you were beginning to be worried about the U.S. dollar, and I would assume that given the performance of the dollar recently, that has not changed.
I definitely am worried about it, and every time Bernanke goes up to the hill or does something else signifying that he believes in an easy money policy and trying to artificially lower interest rates, I think it just sends a signal to world markets, and I think that's reflected not only in the value of the dollar vis-a-vis other currencies, but also in the price of gold. We're not anywhere near being a banana republic yet with our monetary policy, but I do think we're heading back to the 1970s, where politicians are pressuring the Fed, and the Fed is catering to the politicians to try to have easy money, and that always backfires in the long run.
Now, Kristen, what about the euro? We've seen some countries choose the euro over the U.S. dollar, but are we at the point now where the dollar is in danger of becoming a second-tier currency to the euro, or is that premature?
I think that's premature, but I think we have to take a longer-term view here. I think it's a little too simplistic to say this is the fault of the Fed and their monetary policy. The dollar has been sliding against its trading partner countries since 2002. There's no acceleration in the decline of the dollar. And basically, the decline of the dollar reflects macroeconomic mismanagement over the last 7 years. I think ultimately the dollar in its competition with the euro will bring some competition back and some discipline back to macroeconomic management in the U.S., and that does include monetary policy, but it does include also fiscal policy.
I have Rick Santelli nodding his head in agreement and Dan nodding his head in disagreement. Rick, go ahead.
I think both our guests nailed all the salient points. Don't worry about what's going to be the standard or not. About why it's getting weak. And it's getting weak because if the Fed says they're worried more about growth than inflation, that's code for they're not worried about the dollar. Pretty simple. And in terms of macroeconomics, well, maybe the best way to fix the dollar is to fix the economy. And if lowering rates isn't fixing what started out as a credit issue affecting the economy, the report card is in the weakness of the dollar.
But, Michelle, the Fed is in such a box, because they're worried more about growth than inflation right now. Maybe that's the correct assumption to make. Maybe it's not.
The other issue is, what can Bernanke do about a lot of this inflation when it's happening outside, due to reasons that are occurring outside the United States? I mean, what do? Do you tell China, don't improve your economy anymore, so your middle class doesn't want to eat better food, and that won't drive up wheat prices, et cetera, et cetera?
What do you think?
He doesn't have much choice.
That's exactly the point here. I think we're giving the Fed too much credit to do too many things. I mean, there is a limit to what the Fed can do. A lot of what we see in inflation is food price inflation. That's been consistent for a number of years, and that's increased demand.
And energy.
But that's a temporary blip off. I mean, the long-term sustained growth and inflation. And on the macroeconomic side, the Fed has done what it can do to stimulate the economy, and I think has proven to be rather inefficient and ineffective in doing so.
Dan is shaking his head again.
Yeah, I want to jump in because I don't often point to Europe for lessons on what we should do, but the European Central Bank, I think, has done a much better job than the Fed. And why is that? Because the European Central Bank has one mission: price stability. We have the Fed with 2 missions: growth and price stability. Well, you can't do that. The Fed
can't
wait a minute.
That's not quite correct.
Because growth means pump money into the system. It's like trying to have a drink to cure a hangover. The economy grows because your real policies are sound, or the economy doesn't grow because your real policies are unsound.
Dan,
the Fed is simply the oil for the gears of the economy, and we don't want to throw sand in those gears with easy money 1970-style policy.
The European Central Bank
they're throwing in certainly isn't Greece.
Guys, can I get in here? The European Central Bank has not been soft on interest rates because it doesn't have to be yet. It didn't face this housing crisis. It didn't get affected nearly as much by a subprime crisis. And when it does, and when growth in Europe really slows down, you watch, they'll be lowering those interest rates.
They're going to cave just because they watch the euro.
For the first few years of its existence, the ECB was worried about the euro and import inflation and the high value of the dollar. I think the euro is just rising because there's pressure, overall macroeconomic pressures on the dollar, and the easiest way to adjust that pressure, to relieve the pressure, is with the euro. It has very little to do with European policy.
You get better yield, right, Rick Santelli? I mean, you're not getting much bang for your buck in the buck.
No, anybody investing in treasuries, they're wealthy. They're protecting their credit. An average American shouldn't probably be buying treasuries here. But Dennis, talk to UBS when you don't think Europeans have the same losses. The reality is the Fed, it's not that we're giving them too much credit to fix what they can't fix. We're not giving them enough credit as to the problem, because if they weren't easing so much, Europe buys their commodities 50% cheaper. That's been the big move against the dollar, and that really is the issue.
On that note, please all come back. Thank you so much. Michelle, Dennis, we'll see you again in just a second. A quick break on Power Lunch, and then we will talk more about the credit crunch and the exotic securities producing the fallout that is now way beyond Wall Street. Melissa Lee said